So as a real estate investor, I always try to look at different real estate cycles, different markets where different things are happening. I read an article today about all these apartment buildings in Houston that are going to go up for foreclosure. Now, it wasn't very many years ago that all the articles were saying, Houston's one of the hottest markets in the States. There's all this development happening. And now you're seeing large numbers of big multifamily properties that are going into foreclosure. And so it's good to look at something like that, see what happened. What did the market look like right before? What was causing investors to buy there? And then what changed now that's causing them all to go into foreclosure? So in Houston, it's a little bit of a different situation. In the States, a lot of the big institutions and apartment investors, they buy using interest-only debt. And I remember a couple of years ago when they were talking about that, it was kind of everybody took floating debt because it was way cheaper. You'd take a 5-year term. So you're not paying any principal down and you're taking a variable rate loan. When interest rates change very quickly, there was nothing those buildings could do. So it wouldn't matter if rents went way up. You couldn't get out of that hole because your debt payment might have went from 50,000 to 150,000 a month in a very short amount of time. So you couldn't get that income back. So anyone who wasn't capitalized well is really feeling that now, right? But it's important to look back and see, in the beginning, that was the place to do it, right? And you were going to just hold that loan for 5 years. The building was going to go way up in value. You'd refinance all your money out, and you were in a great position. Nobody's seen interest rates going up 5 times in a very short amount of time. And all of these investors, a lot of these were big institutions. They weren't dumb people. They just kind of got unlucky, right? All the biggest companies in the world were taking these floating rate loans as well. The difference being they can sustain this now. If they have to, just hold on to these properties, it's a term that I think they even used in this article. It was extend and pretend. So you just try to get longer debt and just make those payments long enough, right? There's a saying, survive till 25. If you can just stay alive, if you can just keep the building till then, interest rates will go down. Now rents have went up. You're going to be in a good spot again. But it's the holding it that's the hard part, right? It's and even going into this cycle, that's why it's important to look at other places and then look at where you're at. Right before this, it was the best time ever to invest there, right? People were moving from Canada to invest in Texas, and you'd see all of this stuff. And now it's, now that they're in a bad spot. So it's like the quote, be fearful when people are greedy and be greedy when others are fearful, right? But that's a lot harder to do than it is to say when you're seeing all these people make all the money. And the greedy part is you want to make that money too. You see rents going up and prices going up, and you think, if I could just buy now and refinance out right away, that's a huge amount of money. And on the flip side, it's like, it's scary when the market's going down, rents are going down, all you're hearing is negative news. That's a very hard time to buy because you never know when the bottom is. It might have went down 10%. You might buy and it might go down 20%. But there's usually going to be an opportunity. So even now with these properties in Houston, the banks are probably going to let those properties go to somebody new for just the debt that's owed. So if they had leveraged these at 70%, you might be able to pick up properties at 70 cents on the dollar or maybe 80 cents on the dollar. You've got, you can put better debt on today and extend it out. So there will be an opportunity there. And it also is going to wipe out a lot of people if not many people can take losing whatever amount of money they put down on these properties. So the big guys will be there still. Some of them might go away, but the competition will be less than it would have been 2 years ago when the market was really hot. So maybe opportunities like this, when things go bad, are chances for smaller guys to pick up more property. A lot of the big guys, it's not every time, but it's kind of a saying they're the first to leave and the last to get back in. So right, they make decisions slowly. Generally, they're making decisions that are very safe. So they do want to see that it's hit the bottom before they come back into a market. So it might open it up for smaller operators to come in, pick up some of these properties. If you're looking at somewhere like Canada, where we're way undersupplied on housing and that problem's getting worse every year, even if things do change, if prices change and rents go down or they go up, over a long enough period of time, you can look at our housing starts and our immigration numbers and have a pretty good idea what the future of housing is going to look like here, with our dollar the way it is or the inflation where it is. What does that look like in 5 years or 10 years for the housing market, right? What are housing starts today? What were they 10 years ago? What are they projected to be? And what are our population growth numbers? And you can look at that and say, hey, even if the sentiment is down, I think it's a good time to buy because over 10 years, that's going to come back. So that's something where if you look long enough term and you look at enough cycles, you can get a pretty good understanding of where the market's going. And when there is a market like this, in Houston, let's say where buildings are starting to go back to the bank, going into foreclosure, you almost have to block out what the people paid for it, what the debt was on it, and just re-underwrite it as if it came to market today. Because they're two totally different things. They bought that building at a point in time. It really doesn't matter to you if they lose 20 million on it or if they made 20 million on it. What does that look like today? If you underwrite it today with today's debt, and that's all you really need to know, right? It doesn't matter what the previous person had it under contract for or what, how much money they lost. It's just what's its value today? What does that look like 5 years from today? So obviously this happened in Houston, mostly due to the debt, right? A lot of people had floating rate loans. Now their payments went way up, can't sustain it. In Canada, it's slightly different where most people on multifamily have locked in rates. But you can look at that and say everything bought in, 21, 22 with very low interest rates, if they took 5 year debt, when did those loans come up, right? Because I doubt that in a couple of years we're going to be back to 1.8. So what does that look like? Has rents went up enough that everyone's going to be safe, or are people going to look at that and say, hey, maybe we're just going to sell it before our loan comes up because this building, I don't want this building now at a 4% interest rate. So you can see how many loans came up or were taken at a certain time, when they're going to come due, and if that's going to cause a big problem, right? If people didn't take CMHC, maybe they took 3 year loans, or maybe some people did the Burr strategy and they took temporary debt 2 or 3 years ago, and those loans are going to be coming up now. So it could cause that opportunity. It's a different debt market for sure, but it's something to look at. So yeah, it's just a reminder to always look at other markets, look at other cycles, and then try to project that into the future. And obviously no one has a crystal ball, but it can help you with your strategy. Thanks for scaling up today. We'll see you guys next week.